I've heard of prison REITs in the
Prison REITs?
Prison REITs in the US.
No. How does the structure of the REIT get created?
It's still a small number, but from 6,000, 300,000 is a big growth. That's a wrong way of looking at it. Just looking at the dividend yield. September, third week of last year, you would have made a return of 36%.
Why was it beneficial for you to acquire assets in the SEZ?
We also got SEZ benefits.
Sure.
What you get, most of it is tax-free.
The jury's out on physical real estate as an asset class. We've had debates right here about it. Some people swear by it. Others say the acquisition cost is too high, to say nothing of the opportunity cost. But what about fractional ownership? What about real estate investment trusts? How do they work? And if they are meant to allow you to invest in real estate assets, why has the SEBI tagged them as equity? What are the tax implications? This is MoneyWise on NDTV Profit, and my name is Alex Matthew. Joining me in studio is the man with the answers to all of those questions, Ramesh Nair, the Managing Director and Chief Executive Officer of Mindspace Business Parks REITs. Thanks so much, Ramesh, for taking the time. Let me start with the most basic question. What is a real estate investment trust?
So REIT is a pooled vehicle which invests in different asset classes. I work for an office REIT. We get rentals from the various clients who occupy these buildings. We deduct expenses. Then there is interest payments after that. And after that, we distribute the income to the various unit holders. So as simple as that, like a mutual fund invests in the equity markets, we invest in a particular asset class, in this case, office real estate.
Okay, so a number of questions already emerged from that one statement, right? You invest in office real estate, so the natural extension of that would be that there are REITs that exist that invest in residential real estate and that invest in the other type of real estate, which is retail, right? Which is malls, etc. So where do they exist? Do they exist here in India?
So in India, we have only 5 REITs. The first REIT came up in 2019. And since then, 5 REITs have listed. So 4 of them are office and 1 of them is retail. Between the office REITs, they own around 165 million square feet. The retail REIT is around 11 million square feet. Overall, when you look at the Indian market, we are talking of a market cap of around 1,50,000 crores with a AUM of around 2,25,000 crores. Compare that to US, where REIT as a product has been there since 1960. We're talking of a market cap of close to $1.9 trillion. Today there are like 1,000 REITs across the world in 40 different countries. Multiple REITs. So in US you would have rental REITs, they would have large data center REITs, there would be industrial and logistics REITs. I've heard of prison REITs in the
Prison REITs?
Prison REITs in the US. There would be resort REITs.
So the implication of that is that a prison earns money.
Rental income.
So it rents out to the state.
Yeah.
So it's privatized prisons that rent it out to the state, and the state pays a rent, and that gets distributed. Wow, yeah. I didn't even think of that. Okay, so but let's talk about the fundamental objective of a real estate investment trust, right? It is a vehicle that allows an individual to participate in investing in an asset that would otherwise be difficult for them to invest in. So we're talking about, especially we're talking about office spaces, it's very difficult for an individual. It's practically impossible to buy the same building that an Infosys is renting, right? Exactly. Whereas you will have IT service providers that are renting businesses or buildings that you own. So as a REIT, ultimately the primary cost for you is the acquisition of the building. Do you at all get into the building of buildings?
Yes.
The construction of buildings?
We do.
How does that work?
So from our point of view, we have a 37 million square feet portfolio. In that 37 million square feet, 30 million is ready. 7 million is actually under construction or under development, getting different approvals. So it's a mix of ready and under construction.
Okay. So, and who does the actual construction? You would contract a developer or builder or basically an EPC mode you would effectively get this done, right?
So we would typically partner with people who understand that. Here in this case, our sponsor, K-Rager Corp, has a very large in-house construction team, and we would give them a fee for constructing the buildings.
Okay. So, like I was saying, the primary objective then from the perspective of the REIT, first we'll talk about the REIT and then the individual, right? So the REIT ultimately is an entity that is created to own a number of real estate assets, physical assets. It will then serve as a landlord for those assets. It's responsible for getting clients to come and live in those or utilize those assets. It will collect the rent. It has certain overheads.
Yes.
The management of those assets are the REIT's responsibility,
Yes.
and it makes a certain profit.
That's right.
How do you decide as a REIT what the spread of your assets will be, and where do you get the capital from? Is it through the initial primary issuance, or do you already have a certain asset pool and then you go and you list and you basically have unit holders come in? How does the structure of the REIT get created?
So from our point of view, as per SEBI regulations, you are supposed to distribute 90% of your net distributable cash flows back to your unit holders. So for growing, for investing more, we need to go to the capital markets. So capital markets is either looking at debt or looking at equity. Today, we have a debt of close to 10,300 crores. So that's the debt we have taken over the years to grow our REIT.
Okay. No. So, but how does the ownership structure of the REIT work? Ultimately, you're talking about a trust. And so there will be original sponsors of a REIT, and then ultimately you increase the number of participants or owners of the trust, right? So how does that structure work?
So initially when we listed, there was a lot more interest from foreign FPIs.
Yes.
Today what we are seeing is there's a lot of family offices who are interested, HNIs who are interested. There was Blackstone when we initially listed who used to own 15% of the REIT. Blackstone then sold it to Abu Dhabi Investment Authority. And Abu Dhabi Investment Authority in turn today has sold it to multiple mutual funds.
Sure.
So today the ownership is 64% of our REIT is the sponsors. Balance is FPIs, retail investors, insurance companies, pension funds. So it's a mix of all that, the balance 36%.
And broadly, would you say that REITs in India are owned more by institutions rather than retail investors, individual investors?
That's changing. So the early days when the first REIT was listed in 2019, we were the second ones to list in 2020. Initially, most of the interest came from FPIs. That's kind of changing. And today, there's a lot more HNI interest. So the first REIT, Embassy REIT, was listed in 2019. There were only 6,000 retail investors back then. Today, there are close to 300,000 people who have invested in the REIT market. But again, when you look at 300,000 people, with the 11 crore people who invest in equity markets in India and 5.5 crore people who invest in mutual funds, it's still a small number. But from 6,000, 300,000 is a big growth.
I'll come back to the scope of the buyers and how that is expanding and what the implications are for supply demand and ultimately the prices of the REIT. Let's come back to the perspective of the REIT, right? So ultimately the price of the REIT per unit is described by your share price that is tradable on the exchanges, right? You mentioned that you have assets under management of a certain size and you have a market capitalization of a certain size. Why is it not at parity?
So typically what happens is a REIT is valued based on 2-3 different principles. Somebody looks at a professional valuer who values, as per SEBI, we are supposed to value it twice in a year. So he looks at a fair market value based on, he discounts future cash flows and arrives at a fair market value, which is called the GAV, the gross asset value. From that, you deduct debt, you deduct security deposit, is what you arrive at your NAV. So NAV is supposed to be the true value.
Reflection.
True reflection. Sometimes there is a premium. Sometimes there is a discount because the market is also going up, right? Like what we saw in the Hyderabad market, just last financial year, we saw the average rentals in Hyderabad going up from around 75 to 90, still climbing. Efficiency rates which occupiers were willing to pay. At once upon a time, occupants wanted 80% efficiency.
What is an efficiency?
Efficiency basically means carpet area to the leasable area ratio. When you pay for 100 square feet, how much area do you get as carpet area?
Okay.
Used to be 80 square feet once upon a time. Today that's dropped to 70, which means you have more space to lease. So when these kind of things happen, when the market goes up, when there is a lot more rental increases than normal rental increases, which is typically 5%. In a typical contract, the client has 4.5 to 5% rental increases. But sometimes the market shoots up. There could be a client who's paying 50 rupees rental, who's decided to vacate, and we could lease that same space at 100 rupees, which actually happened last quarter for us. Because the client who had a lock-in, he had a lease term ending, who ended up leaving, we get that opportunity, what we call the mark-to-market. So these are the ways one increases the value. We also increase the value by doing external acquisitions. External acquisitions can be acquiring from third parties. External acquisitions can be acquiring from our sponsor. Today, a sponsor has close to 18 million square feet, which is at different stages of development and completion. External acquisition can also mean where we have joint ventures with the landlords. Let's say we have a 1 million square feet project, the landlord owns 300,000 square feet of it. Over a period of time, sometimes landlords tell us that, okay, I want to
sell it to you.
I want to sell it to you, and they would first come to us because it obviously increases their overall value proposition when you're part of a larger park. So all these things help increase your gross asset value over a period of time.
And so it's much more than just a reflection of the real estate that you own. It's the expectation of how the yields or the rentals will move up over a period of time. Effectively, it is a measure of future value which gets discounted at the current level. Like any other equity.
Like any other. See, the key thing here is a lot of people look at REITs as a yield product, which is a wrong way to look at it. Yields today are around 6%.
Explain that for the benefit of, and I was coming to yield. Sorry to interrupt you, but I want you to explain this concept so that people understand this and why a lot of people traditionally looked at it and compared it to fixed income products, because ultimately your yield often is spoken about in the context of a debt product, of a bond, right? So you have an investment that you make in a bond, you get an interest or a coupon payment, and so if you hold it to maturity, you get a yield. In this case, you're talking about a real estate asset. You have invested in a REIT which holds a certain amount of real estate that cost a certain amount of money, and on that investment, you're getting rent. And that rent as a percentage of the overall cost is looked at as the yield, correct?
That's right. That's right.
So why is that the reason why people have compared it to a bond or a fixed income product? Because more or less is predictability on how much you're going to get as a yield, right?
See, there is definite predictability that whatever you could get a yield between 5.5% to 7%, depending on which REIT you have invested in. But that's a wrong way of looking at it, just looking at the dividend yield. Last week you saw the returns on Sensex over the last 12 months was nil. Same time, if you had put money in Mindspace REIT exactly a year back, last week, last September, third week of last year, you would have made a return of 36%.
Including the capital appreciation
of around 30% and yield of around 6%. That's the way to look at a REIT. I know things are not always going to go up.
It's not linear.
Yeah, it's not linear because you could have a COVID year, you could have a global financial crisis kind of a year. But even if you look at a 5-year period, we just celebrated our 5 years since listing. In the last 5 years, imagine the kind of things which have happened in the world. We had COVID. Everyone wrote off office. There was work from home. Everyone is working out of homes. We had a lot of SEZ vacancies which were happening. In spite of all that, if you look at it from a 5-year period, on an annualized basis, we have given more than 15.5% annualized returns.
Inclusive of the yield that you...
Including
and the
yield
dividend
and you basically where the share price has gone and the dividends which we've given. If you have to kind of divide it by 5 years, you're given a
15%.
15.5% plus, which is which in a world which is so uncertain, in a world which is there's so much of volatility, I think giving that kind of returns is quite commendable.
Okay, certainly. I want to get into some of the aspects because, yes, you're seeing that the last 12 months has been great, right? But there was a period of lull. In fact, if anything, the last 12 months has been catch-up. And there were a few niggling issues that came about. Something about special economic zones, something about, the renters in those markets. What happened?
So 3-4 things. So I'll first talk about the market and then go to SEZs. Back in 2021, the office market demand was around 25 million square feet, net demand of office. That's come back to 50 million square feet. So office absorption, a lot more.
Because people came back to work.
Yeah. And companies growing. They didn't grow in 2020 and 2021 because of COVID. Vacancy levels, which used to be around 18%, today is dropped to 14%. Back in 2015, most corporates would look at an SEZ where demand for SEZ versus non-SEZ space was 50-50.
Okay.
Why would they go to SEZs? Because most office demand came from IT services companies, large IT companies, and they were getting the tax rebates in an SEZ. That had changed by 2020 because the tax benefits had gotten over in SEZs.
Sure.
So demand became 90% of SEZs and 90% non-SEZs and 10% SEZs. So 50-50 became 90-10. And all the developers were left with vacant SEZ spaces, including us.
Okay.
So the government in 2023, highly supportive government, who came out of the rule that even if you have a floor vacant in an SEZ, you could convert it into a non-SEZ by paying a certain fees to the government.
Because I just want to clarify, so those SEZ properties were available to you at a discount or at lucrative prices? Is that, or was it the tax rebate that...
We own those properties.
I know, but
tenants were not showing interest because the tax breaks...
No, but I'm talking about why was it beneficial for you to acquire assets in the SEZ?
We also got SEZ benefits.
Sure.
Construction costs would have been 15 to 20% lower on stamp duty, custom duty, all those things.
Which is why you had to pay the government a cost to convert to non-SEZ.
Non-SEZ.
Right.
So what we have done, for example, is we have converted close to 22 lakh square feet of ours, which was vacant, to non-SEZ space. Vacant SEZ space have been converted to non-SEZ and managed to actually lease 16 lakh square feet of that.
Okay.
So that's worked very well for us, and thanks to the government, they came out of these rules in late 2023. And it's kind of played out over the last 1.5 years. We've been able to increase our occupancy. Back then, our occupancies used to be around 87%. Today, our occupancy is nearing 94%.
Okay.
So we've been beneficiaries of that rule change.
Okay. And this is a process that is ongoing. There's still more to go. And when do you see that completing?
So it depends when. Even today, we have a lot of SEZ space, which is occupied by various occupiers. We can only demarcate it when they leave the space.
Right.
And we also have to wait till one full floor becomes vacant. Let's say it's a large floor and one tenant, which is half the floor, vacates. We still cannot demarcate it. We'll have to wait for the other tenant also to go to demarcate.
So the potential for occupancy is actually much higher. It can go maybe on the next 1.5 to 2 years. What is the average lock-in period that people get into? What is the kind of terms that people get into?
Typically, occupiers sign a 10-year lease.
Okay.
Lock-in periods vary between 3, 4, 5 years is the lock-in.
We've talked about the potential. We've talked about the fact that it's a steady state earner. There is potential for capital appreciation also. We've spoken about the various reasons why that is. Now, I do want to ask about a couple of things. One is that the recent tagging by the Securities and Exchange Board of India of REITs as equity. And you made a statement. You said that it shouldn't be looked at as a rental asset or yield asset, and you've spoken about why. What are the benefits of being tagged as equity? Does that mean that there will be more buyers that come through, especially in the mutual fund space, where now in a number of categories they will be able to include REITs in their portfolios?
So simple logic, Alex here. You widen your investor base. There's a lot more interest. There's better price discovery. There's more liquidity. So let's look at the Indian mutual fund sector. Close to 75 lakh crores, the mutual funds
Assets under management.
Under management. Out of this, 60% are equity funds, around 20-25% are debt funds, around 8% are hybrid funds. Because we were classified as a hybrid fund, there was always a confusion if we are a niche product or a mainstream equity product. Today, that confusion is over. We are no longer a hybrid product. We are a simple equity product, which means we would get included in various indexes, which means, let's say, there are these large American ETFs, which are the index funds, which are there, who would have a Asia allocation, a India allocation. We would have that kind of money coming in. And given that the product to the market, being an equity product, has been simplified, we feel there would be a lot more retail investor interest also. Mutual funds silently have invested like 30,000 crores in REITs over the last few years.
Okay, so we've covered a lot of ground. But let's also talk about the tax aspect of it, because ultimately there are two forms of earning in this. You either have capital appreciation, as you've described very aptly, and you also have a regular distribution by the REIT to unit holders. How do you ensure, or how do investors in your REIT get taxed? I ask this because there are two ways in which this is calculated.
So from a distribution point of view, what we do is around 55 to 60% is given as dividend, which at the unit holder's hands, he doesn't need to pay a tax. Around 5% is given as interest component, which is taxed at tax slab of what the unit holder is. And balance around 35% is given as capital repayment, where on receipt, he doesn't pay tax, but when he sells, he pays short-term or long-term capital gains tax as applicable. This is one of the key points of investing in REITs, which the market needs a lot more education
on. Yes.
So what you get, most of it is tax-free.
Okay, so and the reason why I asked you this is because there is a second way in which this is calculated, and that is effectively, by the way, if you're wondering about this, is that if the REIT has moved to the lower corporate tax rate, then the unit holder will have to pay tax at slab rate for the entire dividend that is received. But in the case of Mindspace REIT, as we've established it, let's actually drill this down and illustrate it so that people understand. If as a unit holder, I have received 1,000 rupees of payment, or 100 rupees of payment, right? 60 rupees of that
55 to 60 rupees.
55 to 60 rupees of that is a dividend payment for which I pay no tax.
No tax.
5 rupees of that is the interest component for which I pay based on slab rate.
Yeah.
And the remaining 35 rupees gets adjusted with what I have paid initially, my original acquisition cost.
That's right.
That original acquisition cost, this gets deducted from that.
Yeah.
And then what the final value of whatever I sold, when I do sell, is used to calculate the gain or the loss to calculate the incidence of capital gains.
Capital gains. And what we do we do it very transparently. SEBI regulations are there. Once a quarter, when we give these dividends, it's clearly mentioned what is the breakup of all these three aspects.
Yeah.
Once a year, we also send a Form 64B where the unit holders can use this in their tax filing.
Yeah, and of course, ultimately, when the sale happens, there is capital gains that has to be booked at 12.5% long-term capital gains, because ultimately it's a listed equity asset.
That's right.
Okay, so it's pretty clear, and I think that we've covered quite a bit of ground. I'm sure that there will be questions that emerge, and I'm sure that we'll have an opportunity to speak again. But thank you so much for joining me today. Absolute pleasure.
Thanks, Alex. It was nice being on your show.
Well, we tried to cover all the ground on real estate investment trusts, and I hope that we've done a good job. Let us know what you think, and if you've got additional questions, like I said, we'll address it on future shows. Thanks so much for tuning in. This is NDTV Profit.